Let me welcome in Neelkanth Mishra, Chief Economist at Axis Bank and Head of Global Research at Axis Capital, who's now with us. Neelkanth, of course, is the number one voice that people sort of look to after the budget, and he's with us. So we're very pleased. Neelkanth, good morning. Great to have you with us here. Thank you very much.
Good morning, Prashant. Thank you very much.
You know, there's so much to discuss. Let's keep it, sharp and pointed. First up, is the interpretation that the government is moving away from infra and focusing on consumption correct? Because it's got implications for markets as such. Go on.
I disagree with that because the limitations on how much the government can do on capex was clear even last year. Remember that out of the 11.1 lakh crores, 9 lakh crores was stuff that the government could control. There was 2.1 lakh crores that they had no control over. So we are hitting the limits on what the government can directly do in terms of capex. And therefore, the guidance from the government was that we will maintain capex as a percentage of GDP year onwards, that the scope for us to do more is now gone. So now they're experimenting with, for example, this 1 lakh crore that they've decided to spend on urban infrastructure, but through a competition mode, so the states need to compete for it. They have to find such avenues so that capex continues, but there is very little more they can do at the central level. So I don't think this is a stepping away from capex.
Absolutely. Neelkanth, in fact, if you could just elaborate on that point, another sort of, statement that's been doing the rounds, or calculation or thought process that's doing the rounds, is that if you add up capex from the states and the capex that will be done via PSUs, and maybe we're still talking about 20% growth, almost 19 to 20% growth, and not the 10%, which is direct capex, which is in line with nominal GDP. So how would you read into this, the form and format that capex will take from here on?
No, I think those are also very interesting points, but we need to take a step back here and figure out that if gross fixed capital formation as a percentage of GDP in India is 32%, and the central government spending is about 3.7%, or say 3.5%, 3.4%, how much more can it actually contribute? So this is effectively less than 10% of overall investment to GDP in the country. Investment activity in the country is going to be a lot more dependent on how well the real estate cycle turns, how well the power generation cycle turns. And I think this almost obsession with waiting for the government to spend an extra 30, 40,000 crores, in the larger scheme of things, these are all rounding errors. Remember that the fiscal space for the government was very limited. In fact, in the preview session that we had in your studios, we had discussed this, that, all said and done, there's only about 1 lakh crores, which is less than 0.3% of GDP in FY26, is that the government has discretion on. I think it is unwise to expect the government to be doing everything. And I don't think it needs to be doing everything. If the real estate cycle turns, if the power generation cycle turns, and both seem to be turning, we will not be dependent on the government to drive up, say, the industrial stocks or the earnings for industrial companies.
You're sounding pretty satisfied with regard to what the government has done on the capex spend front. But what about the approach to markets? How would you alter the approach to markets? Given the consumption push, they've maintained capex reasonably, but we also have this threat coming in from Trump's tariffs. So your take on the equity markets from here on, post the recent correction?
Absolutely. I was waiting for someone to say that. So the budget is now in history, right? Budget was largely as expected. There was a 1 lakh crore of tax cut for the middle class. But remember that the government is still shrinking its fiscal deficit. And therefore, the aggregate impact, or the demand on aggregate impact on aggregate demand, is actually still negative. The Trump tariffs, on the other hand, are going to be, they have triggered something which is very substantial. See, normal wars, and especially if they are being fought in other jurisdictions, can actually be accretive to earnings, and sometimes they support stock markets. Here, there are political objectives being met through economic damage. So knowing fully well that this will hurt the US economy, and that if there is retaliatory action, it will hurt many parts of the economy. And on top of that, to potentially escalate it to Europe and other parts, I think all of this creates significant uncertainty for the economic forecast. And that, I think, is terrible for markets.
But is there you would agree there is focus on consumption now, right? That you would agree with, Neelkanth? and this is after some time putting more money in. And it's not just 1 lakh crore, it's not one time, right? It's recurring. And there is a broader, I don't know whether there's messaging or it's kind of, it had to be done. The move itself is one time, and whether we'll see more moves, etc. So from stock market point of view, consumption, where will this money go according to you? And is there anything investors can do based off this?
Yeah, so that is somewhat easier to quantify. So if you look at the number of people who disclosed income to taxpayers, see if you're earning that much but you're not paying tax anywhere, you're not impacted. So we have to look at the people who pay taxes. So that this eases our job. The biggest impact is for people disclosing earnings between 12 lakhs and 50 lakhs. The number of people affected, because the last data we have is for FY23, was about 58 lakhs. If you extrapolate it to say FY26, maybe about 75 lakh. That's the number of people who will be the biggest beneficiaries of these tax cuts. And most of these people would be in the 90-95 percentile, maybe even higher. The higher ones, maybe the percentage impact will be lower. What is their discretion? What is their incremental demand going to look like? And that's mostly going to be discretionary. So I think that the impact of this directly will be mostly on the discretionary items. So, jewelry, retail, and somewhat, I think the market was responding rightly to this on Saturday, cars, two-wheelers, etc. At an aggregate demand level, remember that the deficit is still shrinking. So, and a large part of the space that is being created for these tax cuts are actually also coming from personal income taxes.
Absolutely.
So whatever you are seeing in terms of better compliance, more people disclosing higher incomes, is now the government has decided to take some bit of that and give it to what was becoming the pillar. So if you compare India's central government's fiscal math, FY19 to FY26, over 7 years, the government has so far seen a very sharp increase in personal income tax to GDP. A large part of that has actually gone into increasing capex because primary deficits are more or less back to where they were in FY19. And so going forward, if you have another lakh crores and there is no ability to spend it directly on the issues that you can control, on the areas that you can control as a central government, then you might as well give it back to the taxpayer, which was actually funding a lot of this capex. So that seems to be the political economy equilibrium.
It is the capex, it is the consumption side of the economy that suddenly gets turbocharged. Because I'm trying to understand from a portfolio shift point of view, what immediately happened on Saturdays, immediate herd mentality, right? Everybody is rushing to consumption, trying to sell out of capex. Now, do you see that only as a short-term market trade, market move, or do you think this will lead to structural shift in portfolio, especially for long-only funds, bigger institutional investors, where they need to now unload on capex a bit and go back to consumption, because you see that is as a medium-term, 2-3 year cycle, perhaps?
Look, 1 lakh crore, which is less than 0.3% of GDP, being shifted to tax cut should not drive a change in portfolios. I think that we have to keep in mind that, one, the impact of this can potentially be higher. So some amount of this will be saved. Remember that this is the segment which also provides a lot of financial saving. But the likelihood of, say, buying a car on EMIs, using this to buy an apartment, a bigger apartment, and therefore pushing up the real estate cycle, and that then driving another investment activity. So I think there are many ways in which this can be spent, and it would be quite myopic to actually limit it to just saying, oh, let's buy all consumption stocks. Frankly, there are other parts of the economy which are also likely to get affected. And I don't think this necessarily swings the government towards more profligacy. Or this is a sign that the government is starting to become more profligate.
Neelkanth, I'm in the mood to look ahead. So the budget we have discussed, it appears it's pretty satisfactory for you. Trump's tariffs could add an element of uncertainty, and for the time being, maybe the markets are ignoring that just for the time being, hoping that things don't get too bad. But let's talk about the RBI. That's the next big cue for the markets as well as for the economy. What are your expectations from the RBI in this uncertain backdrop? You have the rupee that suddenly moved to around 87 odd. It's showing some kind of weakness. Your take, expectations from the RBI?
So, I think the RBI's job is unenviable. There is significant volatility in global financial markets, and I think that will only intensify because now that once you fired a salvo, it will be very hard for the US to backtrack. And if their closest allies in the NATO or in NAFTA, basically Mexico and Canada, they also retaliate, and they're threatening to retaliate. It actually emboldens everyone else that the US goes after this to actually do the same. So I think the economic uncertainty has just gone up dramatically. The US dollar appreciating, because that's a classic response when there is de-risking, and everyone jumps back into the US dollar, makes it much harder for the central bank. But let's look at what they should be doing. I think it is very important to inject back the durable liquidity that they took out, or they were forced to take out because of the FX intervention. So if there is, give or take 5 trillion rupees, 5 lakh crores that was sucked out because they had to sell dollars, at least that amount of liquidity has to be injected in one form or the other. They've started strongly with about 1 lakh crores last Monday. I think more needs to be done. Second, there needs to be maybe some moral suasion, maybe some backing off on, say, the restrictions on the credit deposit ratio, maybe even changing the macroprudential risk weights to target credit towards areas which are relatively safer today, like real estate. So these are areas where the RBI can and perhaps is likely to act.
Ridham Desai is our next guest on the show, and of course their latest note is out. Managing Director and Chief Equity Strategist, India at Morgan Stanley. Ridham, great to have you on the show. There's so much to talk about: tariffs, budget, capex, consumption. But you know what really caught my eye in that note of yours, that contrary to large pockets of the market, where people are saying go to safety, go to large caps, you are still retaining your bias for small and mid caps, and you still see scope in that side of things. So let's open with that, why you don't think that mid caps and small caps are flashing red.
Hi, thanks, Surabhi, and great to be on CNBC. So this has to be contextualized, and we have to bear in mind that the news from outside India is not so good. So keep that aside. We'll come back to that subject a little later in this conversation. But the news from India is going to get a whole lot better in the coming weeks. So we've gone through a mid-cycle soft patch, which has, I think, lasted for about 5 or 6 months. It was rather idiosyncratic, led by extreme weather in August, elections in the first quarter, lack of spending by the government, and a little bit of tightness on the monetary side. So all this has assimilated into a slowdown in growth, which hurts SMIDs the most. And of course, at the starting point, the SMID valuations were looking a little extreme, and that correction has happened. I think we are now getting into a phase where growth will surprise to the upside. The budget reaffirms that. I think this is a growth-oriented budget. In fact, the phrase I've used for this budget is that it's a magic budget, and I'll come to that in a moment. And my expectation is that the monetary policy will back this budget, and the monetary policy will also become growth-oriented. So as far as India is concerned and what we control, I think things are looking up. Of course, as I said at the outset, the caveat is what happens in the rest of the world, and we can come back to that conversation. So that's the reason why I think that after this steep correction, now SMIDs are looking better than they have been for almost 7 or 8 months.
Piece on consumption, really, Ridham. How much will this help in your opinion, and what will see that lift and that help? Which subsectors within consumption, in your opinion?
That's a good question, Prashant. It's not as obvious as it seems. So let's contextualize this. This is about 10 million people, 1 crore people, who are getting this tax break to the extent of 1 lakh crores. And it's not necessary that they will take this tax break and buy soaps from it. Okay. So I think consumer staples is certainly not the place where we go to. Consumer discretionary, I think, is a much better bet. And even there, I think at the higher end of consumer discretionary is where I think you will probably see some of this tax saved being spent. Some of it can actually also come into the stock market. All of it will go to the banking sector. So, so this is how I would break it up. And that's, the dilemma always with tax cuts. It's hard to predict what people benefiting from a tax cut will do with that money. They could just simply deposit it in the bank, or they could go and buy shares, or they could use it to buy some high-end goods. And I think you'll get a mix of all of that. Now, the exact mix is very hard to predict, but it'll be a mix. And all this is actually auguring well for the economy. When you've hit sort of a spending capacity limit and you don't want to do wasteful expenditure, and again, we should highlight this point, and I'll come to this in a second. So just give me a second. When you don't want to do wasteful expenditure, this is the best next alternative you have, which is give it to the people to spend. And that's what the finance minister has done. So kudos to her for that. Now on wasteful expenditure, again, yesterday's newspapers had no mention about this. The subsidy spending of the government has gone back to pre-COVID levels. It's now back to 1% of GDP. And we had achieved a multi-year low in 2019 at 1% of GDP. So it's, I think, 1.07 if I remember correctly. So the wasteful expenditure is, it's almost you're wringing the neck of your spending options. It's like you're tightening your purse strings. And at the same time, you're getting the private sector to increase its participation in the economy. The way I characterize this is that the government, and I think this is common knowledge now, the government did the heavy lifting coming out of COVID because private sentiment was weak. It is now stepping away and reconsolidating the fisc, in a way preparing for the next crisis moment. Because when another crisis moment arrives, if it ever does, you need spending capacity in the government. So you need to be always prepared for it. And now the private sector takes over. This is incredible, actually, if you think it from a stock market perspective. Very few countries in the world have this flexibility which we have, which is we can take the foot off the pedal, consolidate our fisc, and create capacity to address any upheaval that can happen in the coming years. And that is why this budget is magic. I mean, just one of the reasons. I mean, there are plenty of reasons why it's magic, but this is one more reason why it's magic. And I'll come to a third reason a little later, which is the fine print of this budget.
You're sounding very, very optimistic about prospects, and that's good to hear. And in the finance minister, with regard to the budget, the expectations, they are factoring in STT to be much higher as well. So maybe they are factoring in a buoyant stock market as well. Give and take everything, Ridham. How do you change your portfolio from here on? What are your top ads? What have you all deleted as well? I'm looking at it. I think HAL is something that you'll have pulled out, while Titan, Jubilant, those are the ones that you're relatively more optimistic on. So give us a portfolio construct.
Sorry, so I won't go into single stocks, but from a sector perspective, I think you want to buy the banks, particularly the private sector banks. I think that's the easiest trade in the market right now. The stocks are trading relatively attractively, and I think the environment is going to get more constructive for banks. So that'll be the easy one. Then I think you want to buy some discretionary consumption. As I mentioned to Prashant, this budget is, I think, built for an uplift to discretionary consumption, especially high-end discretionary consumption. I would still continue to back industrials, though within that portfolio, you have to realize that there are some shifts that are happening with respect to the subsectors in which capex is taking place. So you may want to orient yourself to that. I think technology looks quite okay. We are getting into a period where spending cycles seem to be going up. Everything else, in my view, can be underweight in a relative portfolio. But this is one point that I will make, is that this market is transitioning from a macro one to a micro one. So since COVID, we've been driven by macro factors. And I think increasingly this is becoming a stock pickers market. So it's really not about the Nifty and where it heads. It's about individual stocks. And I think the dispersion of returns across stocks is likely higher in the next 12 months than it has been in the last 2 or 3 years.
Somebody's a large individual investor has messaged me and said, please ask Ridham about when FIIs will return in the context of all the changes made in the GIFT Nifty. Quickly, if you can.
GIFT City, the GIFT City.
So,
GIFT, sorry, what did I say? GIFT City, yes.
GIFT Nifty.
Yeah, sorry.
Every morning at 9:15, there's a $100 million bid that comes from domestic investors. To do a trade, somebody needs to sell. Either corporates sell through IPOs, and then they'll allow FPIs to buy, or the FPIs sell. So this is the technical point. Okay, the GIFT City changes, I think, are very encouraging, and it should assuage a lot of foreign portfolio investors with regards to taxation, and should encourage them to step in. And these are changes that market participants were pressing for, and the government has delivered. So I would be very optimistic, but I think you need a bit of supply of paper for foreign portfolio investors to turn. Mind you, this selling that we have seen over the past few weeks has little to do with India. It is largely an emerging market problem, and the emerging market asset class does look very vulnerable. We actually did not get to that at all. But what's happening over the weekend and what's likely to happen over the next few weeks is going to create volatility. So people have to be prepared for it. And India may outperform in this volatility, but the Nifty will struggle. If the world is not going up, it's impossible for the Nifty to do its own jig. It's a very large market now in a global context. So it cannot do its own thing if everything else is falling.